There's been a lot of optimism on stage, so you can call me the harbinger of bad news. We're on the cusp of a trade war we've not seen in decades. Some say as far back as the 1930s. Just this morning, we woke up to a possible 25% tariffs on autos, and that's on top of the reciprocal tariffs coming up on the 2nd of April, Liberation Day, he says. Tariffs on imports worth more than trillions and trillions of dollars. And this is coming at a time when growth is already slowing and we're seeing increasing geopolitical tensions around the world. And some are saying this will prompt a geo-economic fragmentation. That sounds scary. But that's where we are right now. A world that has been upended by a U.S. that has abandoned long-lasting alliances like Europe, Canada, and Mexico. The question is, how does the market navigate this? How do you continue to invest and innovate to drive growth? And how do you position for the future? And of course, we have the perfect person to share insights. And Insight, by the way, is my show every day at 11 o'clock, a plug there. Iqbal Khan is president of UBS Asia. He's also co-president of Global Wealth Management. Iqbal, good to have you with us. You know, the environment that we're in right now, are you seeing clouds forming? Is there a reason to be apprehensive? We feel that fear and anxiety in the markets every day.
Look, I mean, you started out with a very, very strong statement around a increasingly more multipolar world. Absolutely, there's uncertainty, and we see that based on the fact that there's higher volatility in the markets, and we are seeing pockets of risks. But equally, I think I'd rather take the other side of your starting and think about the opportunities. So firstly, we believe that now more than ever before, you need to be diversified. Case in point, you look at the Hang Seng index and you look at the German DAX, they're the two more or less best performing equity indices.
From a very low base.
Absolutely. But you could also argue that everything is relative. And you're looking at your portfolio and your portfolio configuration, you need to look at that relative diversification within that portfolio across regions, asset classes, as much as, of course, the entirety and how you're investing. Now, having said that, there's also pockets of positiveness in this world. Europe is starting to wake up. What we saw in Germany and what we're seeing in terms of what is happening in Europe, Europe is becoming, in relative terms, from a lower base, more attractive. I was at the China Development Forum this weekend, and yes, I mean, we just heard the financial secretary speak a little bit about that. There is an openness to supporting consumer demand in mainland China, right? Equally, there are opportunities in the U.S. market, even though we've seen a correction. And there are specific asset classes, just like real estate. We were talking to an asset manager today, a very, very successful asset manager, actually at Art Basel. We had a small lunch on, and he was positioning the fact that real estate will become more attractive because there is relative price differential that they've been seeing in the market. If we go alts, secondaries are going to be interesting because there's this backlog in ECM. Secondaries fund transactions are actually at a discount right now. So I think there's pockets of opportunities. Our key message in a world of uncertainty is think in scenarios. Nobody really knows where this is ending. It feels like a transition period. Nobody really knows how long this transition period is going to go.
If you were to hazard a guess, how long this transition period
I'm not in the business of guessing. I think we need to think in scenarios. You need to be diversified.
The thing is, Some say this has turned out to be much worse than anticipated. We talk about opportunities. Before we unpack that, how are you looking at the risks that we're facing right now?
Well, I think the biggest risk for everybody is to sort of like have this perspective of hope, right? I think everybody needs to focus on the fundamentals. Even if you look at the U.S. economy, you mentioned there is a slowdown in growth. In a number of the fundamentals, you're not seeing that to the extent that you might read in the media. If you look at some of the portfolio companies,
it was the OECD that cut its growth projection. It wasn't the media.
Global growth projection. I'm not arguing with you around is global growth higher or lower. Also, the reduction was not that significant. The biggest question, if you think about risk, I don't think it's a risk question of how much growth we will have or not. It's stagflation. That's the real risk out there. And that's what everybody wants to avoid. And I think most of the central banks, including the Fed, is clearly very, very focused on that.
Do you see a recession in the U.S., given multiple tariffs that we're looking at, given the expectations of a trade war? Prior to the 25% tariffs on autos, there was a chance of, I think, 35 to 40% of a recession in the U.S. Summer says 50. How are you looking at the possibility of that happening?
Look, I think we're not seeing that as of right now. Have risks gone up in terms of having a slower economy? Yes. Equally, if we look at this whole, everybody keeps on coming back to the tariffs, right? I mean, most of these tariffs have actually been short-lived, with the exception of specific tariffs and the reciprocal tariff that's been announced. And let's see how long some of these more significant tariffs are going to actually prevail and exist. If you look at what happened earlier on this year around specific high-level tariffs, you saw them being taken away post-negotiations and conversations. At the end of the day, the question will be how do tariffs really impact the economy, and what level of tariffs impact the economy? If the objective globally, and I'm not specifying onto the U.S. administration, but globally is to actually have a world where you are at the same level playing field and the product makes the difference. If that is, and assuming that is the objective, but if that is really the objective, then this will be a transition period. And this transition period brings uncertainty. That uncertainty has an impact on volatility in markets.
You talked about having a diversified portfolio. Everybody's been talking about a diversified portfolio. Mm-hmm. Even before we went through this period of uncertainty. How does that diversified portfolio then differs from diversified portfolio now?
Look, I think, yes, absolutely. Everybody's always been very focused on diversification. But when it comes down to actual investment portfolios, which are not in a managed solution specifically or in an advisory solution, what happens is investors tend to be regionally biased based on their environment, biased based on what they read, biased based on which currency.
Can you give an example of how this?
So if you look at the U.S. market, for example, you look at the U.S. wealth management market, most of the financial players in the U.S. just offer U.S. dollar accounts. And I'm talking about large-scale financial institutions offering U.S. dollar only. That will probably not allow you to be that diversified on a global scale, with the exception of course, asset classes, but it's all U.S. dollar denominated. Let's look at Asia. Asia has been historically always about 2/3 Asia biased. I mean, as we went into sort of the trough, if I may call it like that, out here in Asia, you had quite a lot of exposure from clients that were, or investors that were very much focused on China real estate, fixed income, and China tech. So one of the things that we've been working on and we continue to work on is make sure that there's that level of global diversification. I think now it's more important than ever because, again, I mean, let's just look at some of the experts and people who invest every day and who have actually been very, very successful in investing. they all are right now focusing on diversification. It's actually quite interesting. So I come back to this U.S. very important asset manager, somebody who really, I would say, is globally very connected. When he spoke to that audience, he started with Europe. Then he talked about China, and then he talked about the U.S. And where I'm talking about a U.S.-based investor starting with Europe, you have people thinking of diversification. You're thinking about there are different movements around the world. Having too much of a local regional bias or a asset class bias will probably not render you the results you're looking for on a risk-adjusted basis.
But even then, it's too soon to be talking about Europe exceptionalism. We've heard that before, right? It's kind of like getting better, but it's too much to be talking about Europe exceptionalism. That's fair?
It's interesting. Everybody likes extremes. Either something's really great or something's really bad. I think we should focus on more balance, right? I wouldn't go as far as saying it's too early. Fact of the matter is Europe has not done well in the past. And Europe is waking up to a situation where there's more focus on the economy and economical outcomes. And you've seen that through material shifts in Europe. It'll come down to sustainability of initiatives associated with government spending, associated with investments in infrastructure, associated with investments in security. All of that has to be sustainable. It's almost like when you look at China, you go back to September last year, where you started to have a reinvigoration of focus on the economy, to the point that now, very clearly and openly, there is a focus on consumer demand and activating consumer demand. At the end of the day, what will work or not work will be the sustainability and discipline and continuity of these policies, right?
Right. And to your point, China is one market that has done well. Are you buying into that story? We talk about how it's moving towards a consumption-led economy, but consumption-led economy takes a very long time. So are you a buyer into the story?
Well, look, I think we need to separate short-term, mid-term, and long-term. Long-term, based on continuity of measures and focus on the economy.
And you've been encouraged?
You have to be positive. Short-term, there are risks. We've seen a valuation go up pretty fast. In relative terms, still cheaper than other regions in the world. And a lot of this has come through catalysts. I think at the end of the day, you always have a risk of rallies that people are buying the news and selling the facts. And once they see profits, they continue to then also realize some of these profits. So I think over a mid to long term, we are overall positive Asia. We've been here for more than 60 years. We've been in mainland for more than 30 years. We have a pretty significant Asia franchise.
What are you seeing from flows? What are you reading from flows?
I mean, what you've seen this year is China flows have increased in terms of trading volume. If I just focus on trading volumes, India trading volumes actually decreased, right? Japan's been pretty good. So from an Asia perspective, you could argue that you have seen a significant increase in China volumes. Now, having said that, trading volumes are also suppressed pre-September last year, and I think we've seen a continuation of news coming out of China that would suggest a continued supportive environment for the economy.
When you talk about China, you have to talk about DeepSeek and how that was that Sputnik moment, some say? No? Yes? Someone came up with that? Is this China showing its capacity for innovation? It's not just DeepSeek. You have Manus, you have Quark, and many more will come to the fore.
Well, it's interesting. you talk about the DeepSeek moment. I'm sure that it created a lot of excitement, and clearly it showed that China tech needs to be taken into consideration and could be viewed as, in relative terms to other tech investments, as probably not as expensive. Having said that, while you see the DeepSeek moment, last time I looked, China is the leader in photovoltaic. I think we all need energy because everybody needs to charge this energy consumption, so green energy will be relevant. Number one in photovoltaic. Even, you know, when everybody was focused on heat pumps in Europe, with everything that was unfolding in Europe, everybody wanted solar panels on their roof. Even solar panels that are put in Switzerland are made in China, and not because of the price, because of the quality. EV, the whole battery world, you see China being leading. So I think clearly you do see two significant markets that have innovation and technological superiority, and that is right now the US and China. And I think, again, being Swiss, I would also not disregard Europe completely. And I think there's opportunities to see value in Europe.
Right now, let's disregard Europe. Between Mach 7 and the AI players in China, like BAT, Baidu, Alibaba, Tencent, so on and so forth, where would you be putting your money?
In both.
This is part of the diversification strategy.
In both, absolutely. Right? I mean, you've seen a correction. But again, valuations are still higher in the US than they are in Asia. They're higher in the US versus Europe. So I think not being invested in Asia, not being invested in Europe, at least for this year, has not really worked that well. So from that perspective, yes, I do believe that diversification makes a lot of sense.
One market that has seen a massive correction is India. Is that a blip?
Has seen a correction. Look, I mean, I think as in every market, you have markets that will have a correction and will have a healthy correction. And if you look at valuations in India pre this correction, the valuations started to become quite toppy. Now, I wouldn't link the corrections in the equity market and the slower trading volumes to the economy itself. The economy, the demographics in India clearly are all sort of set to continue to grow at a faster pace. And as of right now, what we're seeing is it is still the fastest growing economy.
So given the optimism in the region...
But also in relative terms again, right? I mean, it's... If you compare India GDP to, for example, China GDP or to specific European markets, there is some way to go also for India. So I think if you look at it, if you look at this from a 5-10 year perspective, we will see continued growth in India.
How are you then investing in the region? What's your expansion plan? What's the strategy? Are you intending to hire more people here, given the optimism?
Well, I think if you look at Asia as a region, China is the most significant market, followed by three markets that are Japan, India, and Australia. Japan is very attractive with everything that's happening. Japan has gone from deflation to inflation. The corporate reform, which allows ownership, has seen inflows from financial sponsors and investors into that market. India has been going quite active and has been pretty hot in terms of activity. Is probably the largest pool of investment as of today in terms of international investment. Australia is attractive in terms of some of the sectors that Australia represents, especially in this world where you will need specific precious metals as much as energy. And China is the most important market in terms of size and scale. And clearly, if we continue to see the developments that we've seen them till now, I think there's some optimism. And we heard it from the financial secretary before. He's sounded very optimistic.
Are you as optimistic? I mean, you have both wealth and asset management business in China.
Yes, we do. Yes.
And how do you see that playing
Overall,
out?
we're cautiously optimistic. Again, look, I think you started with there are clouds in the sky, absolutely. It's not just sunshine. There are risks out there. Some of them have maybe a bit of a higher probability, and I think these are areas to watch. And I think I come back to we need to think in scenarios and need to work through what is going on. For us, if I look at these key larger markets, and I would not want to exclude Southeast Asia in the combination of Southeast Asia, because these are smaller markets than all the others that I mentioned. I think there's opportunity in all of them. In terms of different industries, different sectors, different possibilities of investment.
How is AI changing your perception and your business? Because that is one of the uncertainties out there for companies as well.
Look, I think, and I have to be a bit candid here. I'm not the most tech-savvy individual. I was probably one of the last people to give up their BlackBerry back in the day, and then actually moved to iPhone. Now, I have more than one iPhone, unfortunately, in the meantime. But my point is, at the beginning, when you started to see all this hype around AI, I'm probably more of a cautiously optimistic individual, and I was questioning how this is different to what we've already done before. But now to see that computing power, see these large language models, and then agentic AI, I personally think there is unbelievable opportunity in terms of simplifying the value chain. I mean, if you imagine, and I know a number of you go through this, right? Opening an account and running that life cycle is almost like going to the dentist sometimes in terms of your experience. I think agents and large language models can simplify that entire value chain. I think there is this opportunity of a lot of productivity, more client time for our people, but then there is another opportunity. I think one of the things that technology has done is democratize or make it more exclusive. What do I mean by this? If you look at the internet, that internet democratized information. It did. Everybody,
Had access.
our kids, Google if they need to know something. Now they will use AI if they need to know something, and even potentially write an essay. I mean, there's a reason why some of these things are not allowed in school. I think, and then you had social media democratize freedom of speech. We've seen that in specific regions and unfolding. AI has the opportunity to democratize wealth management, making it more accessible. It could go as far as family office services that are available to people that actually can afford having a family office. Specific services like that can be covered through agents in the future. But that will not be for everybody, but it will be more accessible. Even today with AI, you've got AI doctor. I mean, the whole health space is potentially radically going to change. If you could have AI supporting your health, a lot of people have their health bands and everything. A lot of that is technology-driven and supporting. Imagine you could have that for your wealth or for your family office. So from that perspective, I think technology where it is right now, computing power where it is right now, there's a significant opportunity. And I would not underestimate DLT either, and I'm not referring to crypto. There are material use cases coming out around DLT, combining it with AI. So I think there's a lot going on in this space. We're pretty excited. We're investing a lot of money in this space. I think this not only will drive productivity, but also new channels as much as new markets and new frontiers for us.
And on that hopeful note, please join me in thanking Iqbal Khan. Thank you so much for your time.
Thank you very much.